So we've looked at the main parts of the chapter here. We've got through internal controls, the bank reconciliation, and the journal entries. And the last thing we're going to look at is petty cash and how these are accounted for. So a petty cash fund is a fund containing a small amount of cash that is used to pay minor expenditures. So typically a business, because we talked about controls around cash, often purchases aren't done by cash. You go to a store where you have credit and you buy something, it's done on account and an invoice comes later. Or if you need to pay a check, might be used to have that control where someone who's authorized needs to sign the check. So paying in cash is risky because that means someone holding that cash and they could steal it. So cash payments don't happen that often, but at times it's necessary just to have some cash on hand in the business to pay for these minor expenses as they come up. So let's say, for example, that you decide people are working overtime, so you're going to order pizza. Well, maybe you want to have cash on hand, so when someone delivers that, you can quickly pay with cash. Or if it's someone's birthday and you decide to buy flowers or muffins or cupcakes or cookies or something like that, it would be easy for someone to just run to the store, pay for that with cash. Because of this, businesses often have a small amount that sits in cash somewhere stored in what's called a petty cash fund. So we'll write the definition here. Again, it's a fund containing a small amount of cash that is used to pay minor expenditures. A fund containing a small amount of cash that is used to pay minor expenditures. And as it says here, and I said, companies keep cash on hand to pay these small amounts. But because it's cash, and we discussed this is where there's most risk, everybody wants cash, internal controls are necessary to make sure that theft is not possible. Or if it is, that it's recognized and someone can pay those consequences. So ways that you can do this: first, you designate a custodian or some employee who is in charge of the petty cash fund. So we're giving them the authority and the responsibility. Then you just keep a very specific amount of cash on hand and make sure it's in a secure location. So typically some sort of lockbox or a locked office or locked drawer, something like that. And then you need to support or prove all of the payments out of the petty fund with a petty cash ticket or voucher. So a little piece of paper that says why cash was given out. So for example, if someone ran to the store and got those cookies that we talked about, they would need to give a receipt as well, as is the next one. So the receipt, but they would also fill out this voucher or ticket and say, we paid $20 for cookies for Sally's birthday. Here was the date, and they would sign it. And it would also be signed by the custodian or the person controlling that cash. So that's tracking it. Then you also need someone to do that double check. So you could have a person who does a surprise audit of these funds and ensure these receipts actually match the tickets and that the cash agrees to what it should be based on how many tickets have gone out. When I worked as the controller for Deerfoot Inn & Casino, we had something similar to this. So I'll just go through this so you can see in real life what an example of it could be. So there was a site controller who was at the casino in Calgary. So she was an accountant there, and she was the one who was this custodian or the employee in charge of the petty cash fund. If someone came to her and they needed to go pay for something, they would typically try and ask her first. So often it was the repair guy who would just need to quickly run to the store, grab some supplies, come back and fix something. So in that example, he would get approval. He would sometimes get the cash from her first or just come back for a reimbursement. But he would have a receipt for the purchase and he would be given the cash to cover off those expenses. So if he paid them personally, he would come back with the receipt, say it cost $80, and the controller, she would give him that $80. He would also fill out a petty cash ticket to say why he was purchasing those supplies, like what was he fixing that those needed to be purchased, the date. He would attach the receipt to that and he would get that cash. So that went on throughout the month. And then at the end of the month, the custodian or this controller who was in charge of the petty cash fund, she would do up an Excel document to show all of the vouchers. So each one of these tickets or vouchers, why the cash went out, as well as what account it would be recorded for, if it was an expense or an asset. She would then send this along with any receipts and those tickets to head office. So to me, I would review them. So this wasn't a surprise audit, but it was something every single month this was reviewed. And then once we reviewed them and everything was okay, we would replenish her cash. So give her whatever money was used in that month, give her that cash back to get this petty cash fund up to the full amount that it was supposed to be. So lots of controls in there to make sure that cash isn't going missing, that we know who's using it and where it is going. Okay, so there's now how we're going to look at some examples of the steps when you have a petty cash fund. So the first thing that you need to do is create that petty cash fund. So if you've never had cash or a petty cash fund and you decide to, you need to set this up in your accounting records. So the example here, we assume on January 31st, the business creates a petty cash fund of $400. The journal entry to start this fund or to create it, we will debit petty cash so it gets its own account because it's no longer in the bank, so it can't just sit in the cash fund. We want it to have its own account to represent the money that is available. And then we need to take that cash out of the bank, so we would actually credit the cash account because that represents our bank account. And this would be for $400. So on January 31st, whoever is going to be in charge of this, the custodian, they would go to the bank, or someone would, they would withdraw $400. So we would see that $400 coming out of the bank account. And now we actually have that cash on hand in some sort of a locked box available to give out as needed. Okay, so now we've set this up. Every time there is a cash payment, the custodian or the person who is doing that will prepare a petty cash ticket or a voucher, and that will be signed by the custodian and that other employee. So this is done throughout the month, but no actual journal entries are made until the fund is replenished. So obviously we would need to do this at least as often as we do the financial statements, so that we're updating it and recording whatever purchases happened in that month or in the year. So whenever financial statements are done, you would need to do that then, or if you replenish it more often than that, you would record an entry at that time. Okay, so now we'll look at how do we track the petty cash and how do we replenish it. So before it's replenished, and something like this would have been done by our controller when I talked about the casino in my real life example. So you do a reconciliation on a regular basis, at least when it's getting replenished. So continue with our example. On March 31st, the petty cash fund holds $230. in that cash. So that's what you have on hand. And there's also $164 in vouchers. So we need to reconcile this to see if any cash has gone missing. We start with the opening balance in our funds, in our petty cash fund. And we know from this journal entry, we started with $400. So that's what we have as our opening. Then we need to figure out the total accounted for here. So our cash on hand, well, we said we currently still have $230 and we have $164 in vouchers or tickets. So that goes here. So your cash on hand plus your vouchers should equal your opening balance that you started with. It means here's what you gave out to people, here's what you have left. That's the total you should get. So if we add these two, 230, just going to erase this so it doesn't look like it's a negative. 230 plus our 164 equals all total accounted for, which is $394. So we should have a balance of 400 if we've accounted for those. So because of this, it means that we have a shortage of $6. So between the cash on hand and the petty cash tickets, we only have $394. So we're short these $6 to get to our total 400. So $6 isn't that much, but it's never good to have a shortage in cash because where did that go? So this would be something that would likely be brought up. You would ask the person who's in charge of the petty cash fund, like, where did this go? Did you take it? Did you accidentally give it to someone else? See if there was a transaction where there was a ticket missed being filled out. So things like this, you would investigate why there's a shortage. If our total accounted for, let's say, was $404, well, now we would have a $4 overage. So that's always better. You want to have extra, but it would still be weird to have that. Okay, so now we've done this reconciliation, but if we go to replenish that, we actually need to do a journal entry as well. So we need to book these tickets, so what expenses went on to create these $164 in our petty cash tickets. We need to record that on a regular basis. And as I said earlier, typically when you replenish the petty cash fund. So on March 31st, we're going to bring the balance and replenish the fund up to $400, and we record the entry. So we weren't really given this information, but this amount, these are the $164 in tickets. So when we reviewed the tickets, $46 was paid to someone when they went to buy office supplies. $34 was paid in cash for a delivery expense, and $84 related to selling expenses. So these were the $164 that we were given in the question here. So you would record those into the necessary expense that they are, and then we also need to account for this cash overshort. So a cash overshort, this would be an income statement account. So if you're short money, like we are here, it's a debit, which means it's an expense. If you were over, it would be recognized as revenue, and it would be shown as a credit because you made this money. Instead, we have the shortage, so it is shown here as a debit into the cash overshort account. And then we need this $170, would actually, again, go to the bank, get this cash, and put it into the petty cash fund. And this is to top up the 400 minus this well, what are we left with? So we're left with this $230. So that's what we're subtracting. We want to get to $400 to top it back up. And we know we have $230 on hand. So to get that, we have to add $170 into the petty cash fund. Now you'll see that we don't actually change the petty cash balance. It's just still sitting at that original $400, and that's why we're topping it up to get back to that amount that we recorded in this original entry. So if you were to see a question like this, it would tell you the amount of tickets and you would know where to record those. Okay, so that's the end of petty cash. Just a quick look at that. I'll have another example available for you that you can practice for that one. That is it for Chapter 8. Again, we've looked at internal controls. You just need a higher level of understanding of that. And then you really need to know all of the details of a bank reconciliation, how to prepare that, as well as how to do the journal entries that come from that rec. And now just this quick look at petty cash as well. Okay, good luck with your practice.